Welcome to our channel. Today, we're diving into a significant economic event. The Japanese yen has plummeted to its lowest value against major currencies since 1990. This development is critical not only for Japan but also for global markets. In this video, we'll explore the reasons behind this depreciation, its implications for Japan's economy, and the broader global impact. The yen's recent decline can be attributed to several interconnected factors. The Bank of Japan has maintained a long-standing policy of ultra-low interest rates and quantitative easing measures. These policies are intended to stimulate economic growth, but they also tend to weaken the yen as investors seek higher returns elsewhere. Fluctuations in global economic conditions, including trade tensions between major economies, geopolitical uncertainties, and shifts in global demand for Japanese exports, influence the strength of the yen. Economic slowdowns in key markets can reduce demand for Japanese goods and weaken the yen relative to stronger currencies. Currency markets are also influenced by investor sentiment and risk appetite. During periods of uncertainty or market volatility, investors may flock to safe haven currencies, impacting the yen's valuation. The yen's depreciation has significant implications for Japan's economic landscape. A weaker yen makes Japanese exports more competitive in international markets. Industries such as automotive, electronics, and machinery benefit from lower export prices, potentially boosting export volumes and revenue. On the flip side, a weaker yen increases the cost of imported goods and raw materials for Japanese businesses and consumers. This can lead to higher inflationary pressures, challenging the Bank of Japan's efforts to achieve its inflation target of 2%. Depreciation of the yen can impact domestic consumption and investment. While exports benefit, higher import costs may squeeze household budgets and affect consumer spending patterns. Moreover, fluctuations in the yen influence foreign investment flows into Japan's financial markets and real estate sectors. Beyond Japan, the yen's decline has ripple effects across global financial markets. Currency traders and institutional investors closely monitor yen movements, adjusting their portfolios and hedging strategies in response to exchange rate fluctuations. Japan's trading partners, including the United States, China, and European countries, assess the impact of a weaker yen on trade balances and competitiveness. A more competitive yen could potentially affect global trade flows and export dynamics. International investors consider the implications of a weaker yen on investment returns and capital allocation decisions. Inflows into Japanese assets may increase as investors seek opportunities in a depreciated yen environment. Also, Japan will implement tourist taxes to target international visitors. Foreign tourists will be charged more at some local restaurants and attractions, and Japan is even taking into consideration to charge of entrance fees for some of the most visited areas. In conclusion, the yen's fall to its lowest value since 1990 reflects complex interactions between monetary policy, global economic conditions, and investor sentiment. While benefiting Japan's export-oriented industries, it poses challenges in managing inflation and import costs. The response of policymakers and market participants will be crucial in shaping Japan's economic trajectory amid ongoing global uncertainties. Thank you for watching. If you found this analysis insightful, please like, share, and subscribe to our channel for more. Stay tuned for our next video.